Hey everybody, happy Sunday. Happy Sunday. Hopefully you guys are having a wonderful Sunday. So as usual, I always want to just make sure before we start, and in case anybody does not come on here to chat with me on a Sunday, I just want to make sure we're live. So whatever we have that we talk about tonight, it will definitely be cemented on the page. So let me just check and make sure I'm live. All right, perfect. So we are live. So first, I want to start off by saying Happy Father's Day to all the fathers. So I want to put up a Happy Father's Day. Today is Father's Day, so we might not get a lot of people on the live, but I appreciate everybody coming on for Happy Father's Day. And this is my dad, so Happy Father's Day to my dad, and any other fathers out there as well. Also, if you are a father figure, whether it be a brother, a stepfather, uncle per se, whatever, happy Father's Day to you as far as stepping up to be there. And then also, I know sometimes people might not have a father in a home outside of just those other figures. So if you're a mom that's kind of taking that role on as well, I don't want to say happy Father's Day to you, but I just want to say, of course, thank you for doing what you are doing to step up in the position. But needless to say, hey, David, happy Father's Day to you as well. So needless to say, today's live, we are going to talk about of what we're seeing around the nation per se. What's going on, Corey West? Not sure if you are a father or if you are a father figure in someone's life, but happy Father's Day to you as well. We are going to basically have a discussion. You guys let me know what your thoughts are, what you're feeling. If you are new to the channel, please don't forget to subscribe to the channel. Join us in our weekly Sunday discussion, 7 p.m. Eastern time. And if you did miss the live and you are new to the channel as well, don't forget to comment below and put down where you're tuning in from. And if you're new on this live tonight and inside the chat, let us know where you're coming in from on this wonderful Sunday and this Father's Day Sunday. So nonetheless, let's kind of just jump into it. So I wanted to kind of talk about first in regards to, I don't know if you guys are noticing, it might not be as prevalent where you're at as far as the state that you're in. Hey, Angela, how you doing? Happy Sunday. Happy Sunday. Might not be as prevalent in your state. I'm in the Georgia state currently, and we are seeing a shift, as we've been talking about for the last couple months, in regards to the housing market. And not only that, hey, what's going on, Anthony? Good evening as well. Happy Father's Day if you're a father or if you're a fatherly figure. Happy Father's Day. Corey said, thanks. It's bittersweet. Not a father. Lost my dad in 2023. I'm sorry about that, Troy. Corey, I'm sorry about that. But we're going to send our prayers up for you, and we're going to remember that even though he might not be here in the physical, he's always there, spiritually for you. So, but we are going to make sure we send our arms, wrap them around you, and make sure you're okay on this Father's Day Sunday. Anthony said the whole family is here. I see the whole family is here. The whole Matney family is here. I appreciate David for having the whole family kind of join this discussion. So nonetheless, we're going to kind of talk about what we're seeing, what the headlines are kind of reading. If you guys are looking, been looking at the housing market, we're going to jump into this first article that they're talking about in regards to the equity as far as shifting or people losing equity. Let me see if you can see this. If not, I'm gonna make this a little bigger. And again, we gotta remember, when it comes to real estate, it's all relevant to where you're at in your journey as far as real estate. However, this is a nationwide situation in which they are talking about as far as the home equity declining. So I've been noticing a lot just from talking to recent sellers, talking to recent sellers in regards to that might have bought, let's say in 2022, 2023, or maybe even 2024. And now they don't want to, let me put this over here, sorry. They don't want to, they kind of say they don't want to be a homeowner no more. They kind of want to exit the homeowner stage, and they want to kind of go back into living in apartments and renting or per se. And what they're not realizing is that the people that kind of bought in that 2022 at the high point, 2023 a little bit, and then 2024, and it all varies depending on what price point you bought or how you guys saw your market shifting. But some of these people might be underwater as far as equity because they're not allowing the purpose of the real estate to kind of wait a longer period of time so they can hopefully eventually grow some equity there, right? As we all know, real estate is an ebbs and flows, but it's also a long-term gain. So you have to understand the plan of what you ultimately want to do with your real estate before you just go about buying a house, right? But everybody's circumstances are different. So what we're going to do is we're going to jump into totality, their annual home equity declines. It says $4,200 on average as a U.S. home price appreciation slows. So they're saying on average, meaning that this is a nationwide situation, averaging across different nations. David said, I just had someone contact me who is doing this exact thing. Yeah, that's the thing. I've had, I don't want to put everybody out there, but I've had several homeowners that have contacted me that want to sell their house, and they bought in 2022, 2023, or even 2024. And they want to shift back in. They didn't understand. One, the taxes might have appreciated more than they thought would happen. Some of them might have bought a new construction, didn't realize that those taxes were going to shift. Might have went up $500, $600, $1,000. Also, what happened as well, maybe their HOA went up. Also, what happened, maybe their home insurance went up, depending on what type of carrier you have, right? And because of that, people or some of these newer homeowners per se, they want to exit out of the house, or maybe the home maintenance. They didn't realize it was going to cost so much for home maintenance. Maybe a pipe burst, maybe something happened, some type of plumbing issue, electrical issue, HVAC, furnace, roof, any type of home maintenance issue. They're like, wow, this is more money than if I would have just rented an apartment, or if I would have just rented a single family house. I could have called the maintenance people per se to fix these issues. So a lot of people have been contacting me lately, but a lot of these homeowners that have been contacting me, unfortunately, they don't have equity per se in the house right now. So it's very interesting. Corey said, million thanks. My dad was so amazing. I was blessed to have the perfect father. Yeah, no problem, Troy. Corey, I said Troy. Corey, no problem. We have to remember that we only get one original, I should say, biological mom and dad. Well, we get many people that are around us that can support us in that sense, but we only get one biological. So we cherish them. David says insurance and the cost of maintenance. Exactly. So that's what I've been seeing, David, as well. So it's been very, very interesting. So let's kind of jump into what Totality has said in regards to homeownership. It says Totality, a leading global property information, analytics, and data-enabled solution provider, today released a homeowner equity report for the first quarter of 2025. The report showed that the U.S. homeowners with mortgages, which account for roughly 62% of all properties, saw home equity increase by $115 billion since the first quarter of 2024, a gain of 0.7 year over year, bringing the total net borrower equity to over $17.3 trillion in the first quarter of 2025. Negative equity has been rising on a quarterly basis since quarter 2, 2024. Just compared to the first quarter of 2024, the number of residential properties that fell into negative equity increased by 172,000 homes, or 17%. So some of these homeowners, depending on when you bought, you might be currently underwater. You might be currently underwater with the, with your, per se, with your home. As far as, let's just say you bought a home at $400,000. Everything is now selling around you for $350,000. You have negative equity of $350,000. Several homes sell around you, for $350,000. You bought for $400,000, so you bought higher than what's selling now. Now you have, it's a $50,000 gap. However, let's say your mortgage is about $381 because you just bought it and you only put a certain amount down, but yet everything around you is saying like $350. Technically, you're now, you're upside down per se with the equity in your home. How long does it take to equity in a home? So to get equity in your home, it can vary, right? So what we saw in the pandemic is people who got lucky and bought in 2019 or 2021 at the top of the pandemic all of a sudden, just because everything was selling so drastically and so quickly and at a higher price point, people gained equity quickly within a year or two. 50%, 75%, 100%, depending on where you're at in the states that you're in. So normally a normal market, typically equity appreciates every year 2 to 5%. But because the way it shifted up so quickly during the pandemic, I don't really see, and again, I don't have a crystal ball, but I don't see that we will be seeing a lot of equity coming in the future years per se, because I feel like we already hit our peak per se, and when it comes to the equity and how much the houses should be, because as far as keeping up with the income in which people make. So typically, most people will see that equity over several years, and the pandemic, we saw a shift in a year or two, which was crazy. But like David said, he said it would take at least 4 to 5 years just to break even by the time that you factor in the cost of the sale. Clark, would you agree? I definitely agree, David. I definitely agree. It would take 4 to 5 years just to break even, just because of how everything is shifting. But a normal market, as far as seeing equity, it takes several years. We all know about the great financial crash, or in 2007, 2008, where we saw some markets didn't get back until literally 2018, 2019, prior to COVID, or the pandemic era, in which their equity, it took about 10 years for them to get their equity back of what was lost in that time period. And then it kind of just took off in those years. So a normal equity, typically every year you'll see a 2 to 5% increase depending on your market. Some people get lucky, might see a 7% increase, but it's typically a normal market if you're going by the way houses should appreciate, outside of how we're getting, let's say, our income per se, or income keeping up with the housing. It would normally appreciate in that time frame. But like David said, he said in a normal market, yes. In a normal market, typically about 4 to 5 years. But everybody got to understand too that real estate, like we mentioned before on the live, is that it's a long-term game. So when you're trying to buy real estate, you have to sit down. You really have to ask yourself questions. And when you're talking to a professional in real estate that you might want to work with, the lender, talk to your lender. Please have a thorough conversation with the lender. Yes, you could talk to the realtor as well, but the lender is the finance person, right? So you need to sit down and you need to calculate what your lender has. All right, this is my plan. This is what I'm trying to do. What is the right loan that I should use in order to do X, Y, and Z, right? We know that if you use an FHA or a VA loan, it should be in every state, but I don't know. So correct me if I'm wrong, David, because I know you're in Nebraska. But typically with an FHA and a VA loan, you have to stay in that property for a year before you can, quote unquote, turn it into an investment property, right? So I always tell people a year and a day, just because I don't want you to get caught up in any mortgage fraud. So, but typically it's about a year in which you have to stay in a property, and you can, after that, you can then turn it into an investment property. Conventional cash, you can do what you want to do, right? As quickly, sorry guys, I was eating something before I came here. You can kind of jump into that investment property quicker, as far as once it goes up, you can, once you buy it, you can then turn it into a investment property. So you got to have like those conversations. So what is the right loan for me? What are you ultimately trying to do? Do you see yourself trying to buy a property to fix and flip? Do you see yourself trying to do long-term rentals? Do you see yourself trying to do a short-term rental if it's still available? Like in the city of Atlanta now, there are some restrictions in regards to Airbnbs, which are typically known as short-term rentals, where you can't have so many Airbnbs within a certain distance. And then there's also totality as far as how many you can have in total. So they're kind of chopping down, or kind of creating more of a structure in regards to certain things. So you just got to have these conversations in full, so you know that, hey, I'm okay. So say if you're trying to buy a house now, right, and you buy your house, and it might be more than what we might see in the next 6 to 7 or 8 months, right? Maybe equity might drop. The price point might drop some more, which means that you would lose some quote unquote equity from the price in which you bought, right? However, if you know you're staying in this house for 10 years, you might say to yourself, well, I don't care, because I'm gonna be here for 10 years. So if I buy this house for $300,000 and everything around me starts selling 6 to 7 years from now for $280,000, I'm okay with waiting it out for 10 years, buying at this price point, because I know eventually it'll turn over and I will be able to either catch back up to where I bought the house at, or have a little bit more equity on top of that. So you just gotta understand understand your game plan, right? If you pay over asking, do you have equity? If you pay over asking, you can have equity depending on what everything else around you is selling for. So if somebody has a house for 300,000, you pay 320, and then everything else in the neighborhood is selling for 350. Technically, you would have some type of equity, right? Also, an appraiser will tell you too, if when they appraise your house, right? If you buy for 320 and the appraiser says, hey, we have it for 325, then technically you have a $5,000 quote unquote equity, right, from the appraisal per se. But I always tell people you can look at your appraisal when the lender sends out the appraiser as a buyer per se. You can see the appraisal for. You can always ask for the appraisal. I tell people what a lot of lenders are doing now, they're doing automated desktop appraisals. I tell people ask the lender if they can send out a physical appraiser, right? Because at the end of the day, you're paying the same cost for that appraisal. So why not get an actual person to go to the house? And I know some people say, well, I'd rather do the desktop appraisal because it might come back quicker than a person going out and appraising it. I just say you're paying the same cost, and the person that's going out to appraise it, they're taking pictures, they're taking videos, whatever they're kind of putting together to make that appraisal report, and they might see some things inside the house that as a desktop appraisal, they're just taking what they're seeing as far as the comps around, the different images put online by the realtors per se. And trust me, I've seen some properties in regards to in our MLS and even on Zillow and all these platforms in which they kind of get cycled out into these third-party platforms. And then I've gone in person to some of these houses, and let me tell you, some of these pictures be lying. So I tell people just, make sure you get that. If you're going to have an appraisal done, make sure you get asking for an actual appraiser to go out to the property in regards to that. So David said that is my understanding too. Okay. So let's get back into this. So if you guys have any questions, let me know. I know I'm kind of, hopefully I'm not going too fast and not all over the place. So it says strong home price appreciation since the pandemic has ensured that the U.S. homeowners with a mortgage saw a significant rise in their home equity, with an annual gains averaging over $38,000 between 2020 and the end of 2022. At the peak of home price gains, annual equity increases surged to as much as $55,000. However, it says, with price considerably, and appreciation remaining sluggish, home equity is unlikely to accumulate at the same pace as it did during the pandemic or even pre-pandemic, when annual gains averaged about $11,000. In addition, recent declines also reflect that some homeowners are tapping into their equity to finance other activities. And this is another problem too, where some homeowners nowadays too, they are tapping into their equity, right? They're like, maybe you're going through a financial situation, right? Maybe you just got laid off from your job, and maybe you talk to the lender about, you might have called your lender and said, hey, I just got laid off from my job. I might have to take a hardship in regards to paying this mortgage. What's the best option for me? And your lender might tell you, oh, maybe you should tap into your equity. Let me see what's the percentage per se as far as your equity, the loan to your LTV, the loan to value per se of what you kind of owe per se as far as your loan. And they might say, hey, you have enough equity to tap into and take out. I don't advise you do this, everybody, but again, you have to do what makes sense to you as far as where you're at in your life. This is just all of my opinions, you guys. So you have to make sure it makes sense in regards to what you're trying to do ultimately. But I wouldn't advise, if something happens like this, say if you get laid off from your job and you're just trying to make a living, unless you cannot find a way to get another job. Because I know this economy is crazy right now, so it might be hard to kind of get another job right now. But I wouldn't have the first go-to be, hey, let me tap into my equity in my home. I would say, okay, what else around me can I do? Be very resourceful as we are as human beings, right? We're all resourceful. Be very resourceful and say, okay, what else can I do? Can I do a gig job for right now to kind of sustain something, whether it be Uber, Lyft, DoorDash, Instacart, something? Can I find a part-time job to supplement other things as well, to kind of make up for this before just kind of tapping into that home equity? Because then I've seen this happen too. And I talked to a seller about this. I've talked recently to a seller too that wants to sell their house, and they just tapped into their home equity. That's about 2 months ago. So I'm like, it's gonna be hard because so yeah, just be mindful, you guys. Mindful. David said, I agree. Having an appraiser physically visit the home is another layer of protection. Yes, David, I agree. If you're going to pay that desktop appraisal, if you're going to pay an appraiser fee, you might as well pay for an actual appraiser down here, our typical appraiser fee amount when it goes into at the closing table is about $550, $600 for an appraiser, whether it's an automatic desktop underwrite appraisal per se, review appraisal per se, or whether the physical appraisal goes out there. So it's the same amount over here in Georgia. So I don't know about you guys in Nebraska, David, but in Georgia. What's going on, Jaron? What's going on? So right here, so people have been like tapping into their home equity to finance other activities. It says geographical differences are important here as the national average is being pulled down by weakening markets in the South. So again, like we always mention, real estate is local, it's state, it's geographical. So most of this cyclical type of market is being pulled down in the sense of the southern states. So I know every time I get on this live, because it might be different where, where David's at Nebraska, and it's definitely different in the Northeast where like, New Jersey, New York, all these other states. But in the South, since I'm currently technically in the South, well, I am in the South, not technically. I'm in the South. I'm seeing a shift here. And I talk about this with, with my colleagues down here as realtors, and some of them are agreeing that they're seeing a shift. Some of them are, acting like nothing's happening, which I'm kind of scared that they're doing this, but they're acting like nothing's happening. And this is definitely a market in which we have to make sure as people, when it comes to real estate professionals, we have to make sure that we are being honest with people, even if they're trying to buy right now, right? So let's be honest about that. Hey, what's going on, Lang? What's going on? Thanks for joining, Lang. So before we keep going, to Lang, if you guys don't know, Lang's my cousin. And tomorrow is Lang's birthday. So I don't come live on Monday. So I just want to give her a big happy birthday today. And I'll also text Lang and call Lang tomorrow. But I want to wish you a happy birthday on this live because we don't come on Monday. Sorry, my stuff is falling off. So happy early birthday. Jen said happy Father's Day, Mr. Clark. So happy Father's Day to my dad. So let's get back. So a lot of this shift as far as the equity being stripped now is in a lot of the southern states. Right here it says particularly Texas and Florida. It's happening in Georgia. For some reason, every time these reports come out, they don't mention Georgia or the metro Atlanta area that much. But I'm telling you guys, it's shifting down here. So if you are looking to buy in the metro Atlanta area, and if you are trying to sell down here, want to buy down here, just make sure if you are currently working with a realtor, just have these conversations, really in-depth conversations. Do not allow yourself to be guarded in these conversations as a client. Ask questions to the realtor, have a conversation so you can get the best out of what you're trying to do ultimately, right? Because sometimes people be hiding information, and then as a professional, as you keep unpeeling the onion, you be like, wait, you ain't tell me that, you ain't tell me that, you ain't tell me that. So just have these conversations, especially in this shifting market. Do not try to hold stuff tight to the vest, because trust me, it will get discovered. It will get discovered. So Lang said, oh, thank you so much. No problem. Congratulations on your closing, Devon. Thank you. Yes, if you guys don't know, I just recently, a seller client that I had, we recently just closed out on his house. So he was excited. And I was happy for, I got a daggone nag here, y'all. I was happy for him to get to his finish line. It was a house that he had for over 20-something years. So he was excited to get it closed, especially in this market down here in Georgia, the way it shifted. So thank you, Lang. Thank you, Jaron. Thank you, guys. Right. David said, congrats. Oh, thank you, David. I appreciate it. So it says right here that are masking strong equity growth in the Northeast, so the southern states. Says, however, given the weakening of the prices in the South and affordability concerns for existing homeowners due to rising insurance and taxes, in which me and David talked a little about earlier, as well as prevalence, hopefully I'm saying that right, y'all, of natural disasters in those areas which can wipe out home equity, there are many areas in the South where we are likely to see increase in negative equity going forward. So in regards to them saying, disasters wiping out home equity, so again, people, unfortunately, disasters happen, hurricanes, tornadoes, earthquakes, all these things, the fires in California, all this stuff happening. is basically wiping out the equity in people's homes, right? The homes are gone, or the damages are occurring. So those are other things that's kind of messing up the equity. While 1.2 million residential homeowners, or 22.1% of homeowners with a mortgage, are in negative equity, many other homeowners, particularly in the Northeast, are benefiting from the continued rise in home prices and resulting boost in equity. So again, in the Northeast, they're seeing prices rise year over year. In New York, Boston, Massachusetts saw an average equity gain of 20,600, 25,200 respectively. However, on a national scale, homeowners lost an average of 4,200 in equity between quarter 2024 and quarter 1 2025. That's a significant loss when compared to 4,300 they gained year over year in quarter 4 of 2023 and 2024, or the nearly 30,000 annual increase they saw in 2023 through quarter 1 of 2024. So they're saying again that the equity is shifting, right? They saw an increase, and like we all saw, right? 2022, 2023, that's when we saw the highest points in home purchases, right? Home values were high. And as we all know, I don't know if it's happening in Nebraska with David, but we all know prices are shifting down per se, because home prices are unaffordable right now. Interest rates are staying elevated right now. And even though they're not at all-time high interest rates, but home prices are at all-time highs. So that's what's kind of evening it out, right? And because of that, the only thing is either certain things have happened, right? Home prices either going to have to come down, interest rates are going to have to come down. Of course, it'd be great if both happened at the same time. It might not happen. Maybe it will. Again, I don't have a crystal ball, but because of the mortgage rates being elevated in the 6s and the 7s per se, the tariffs also kind of kicked in. Inflation in the economy, all these different things are equating into the negative equity now in people who bought in, again, 2022, 2023, 2024. 2025, if you see what's going on in the market, you see where it's kind of going. If you have a realtor that's kind of can tell you where they think it might go. I don't want to be this realtor that's like this, but I am telling people, I'm personally doing it for my clients. We're going to come under, and I know some realtors are going to hate me for this, but we're going to either come at the price that they have on the market if it makes sense to every comparable around the area, or we're going to go under if it's too high or if it doesn't make sense, because we're going to ultimately try to look at the long run, right? If we can go under $10,000, $15,000, right? And as the months shift, again, we don't know if it'll shift up or down, but if it shifts down, at least we know that it might shift in accordingly to how much you bought it for, and it might even out per se on the purchase price, right? It could shift a little lower, it could go higher. We don't know, right? We don't know where anything's going. I'm just looking at the data to kind of see where I'm just looking at the data and the comps around and looking at the environment and looking at the different factors and say, hey, I think we're shifting this way. We might want to be conservative if you're putting an offer. You don't want to overly put a price in, or if this home also has a bunch of let's say multiple offers occur, right? And has a bunch of multiple offers that occur, right? It might not make sense for you as a buyer. Again, I can't tell you what to do. If you want to go and you want to purchase the house because you really like this house, do what you want to do, right? I'm here to advocate for you, and I'm here to be a realtor in regards to your best interest. But what I can tell you is say, hey, it might not be great to try to get this multiple offer situation right now. Seeing where things are going, you might want to, gracefully back out and let things occur the way they occur. But to each his own. Again, I can't tell you what to do. I'm just giving you the advice, the data that I'm seeing what's happening, and you make your ultimate decision. David said, we are starting to see a slight decrease in prices. It is a return to a more normal market. Yes, we are definitely seeing a corrective market down here in the Metro Atlanta area as well. We are returning to a more correct market down here, a normal market, even in regards to prices, property sitting on the market longer. People got very used to the pandemic, the unnormal being, is it unnormal or innormal? I don't know. I think it's unnormal. The unnormal market per se, right? People got so used to houses getting multiple offers. People got so used to houses being over asking price, meaning higher in price, not sitting that long, people not doing open houses, all these things. People got so used to that, and now we're actually shifting back into what real estate is. Most houses, depending on the market, is sitting on the market for a good, 3 to 4 months. Most times you'll see several open houses occurring, right? You won't see like that many per se bidding wars, right? So we're kind of shifting back into a more corrective normal market, like David said. But people got so used to a certain type of market, which was, to me, I call it a fairy tale market, right? It was a fairy tale. It was a market that was very pretty, and it got everybody excited, and everybody was just trying to get as much they can get out of their home. It created a lot of people to become greedy in regards to how much money can I get. And I get it, right? You're like, oh, I've had this house for so long. You might have bought it when financial crash happened and you were just so excited to get the equity out of it and more. So I can understand it. But then I feel like it kind of started a greed situation. Hey, what's going on, Donna? Thanks for joining us. Thank you for joining us. So let's get back into this article. Sorry, you guys, if I'm long-winded. I'm on this one article and I got several other things to talk about. So I'm going to try to get through this article. I am just very long-winded. I just gotta stop. I just gotta shut my mouth. States across the Northwest saw the most home equity growth. Prices in Rhode Island and New Jersey reached new highs in Q1, with these states claiming the top 2 spots for year-over-year equity gains, rising 36,500, 35,700 respectively. A total of 27 states posted annual equity loss. The top 3 of which were Hawaii. It was a negative 65,900, DC a negative 29,600, and Florida 26,300. Says the national value of negative equity was approximately $350 billion at the end of the first quarter of 2025. So they're saying the equity of $350 billion negative. It says this is up quarter over quarter by approximately 10.7 billion or 3% from 340 billion in the fourth quarter of 2024, and up year over year by approximately 26.6 billion or 8% from 324 billion in the first quarter of 2024. It says despite steady increase in the share of home owners with a mortgage in a negative equity to 2.1%, this is only a slight increase from 1.7% low in quarter 2 2024, and notably lower than 3.6 per pandemic. Negative equity peaked at 26% of mortgage residential properties in the fourth quarter of 2009, based on the Totality Equity Data Analysis, which began in the third quarter of 2009. So let's kind of shift down here. So these are basically showing you the states in which the equity is negative in, or the states in which gained more equity. So I don't know if you guys can see this. Let me know if you can see. I'll make it a little bit bigger. Lang said, we are fine. We are listening and learning. Okay. Okay. David said, I think a fairy tale market is a fantastic description of the pandemic market. Yes, that's what it was. That's what it was. It was a fairy tale market. It definitely was. Let's see. I'm going to make this bigger so we guys, then we'll jump into this next article, which is about investors and them kind of pulling out, corporate investors pulling out. So this is just showing like the different on the map, the United States map. You have negative 12,000 over here in Washington, Oregon, negative 11,000, Idaho, negative 9K. You have different states. You have Wyoming right here. They gained 7,000. Nevada gained 5,000. Kansas 6,000 they gained. And then you wait, it might be Wyoming here. Wisconsin. I'm like, I remember the map, Devon. Remember the map. 9K, Illinois is 9K. And so Georgia, I'm in Georgia, so negative 11K. As they say, the biggest one was down here in Hawaii, negative 66,000 in equity, negative 23 in Texas, negative 26 in Florida. So again, like they were saying, more of the South states, and then you see all the appreciation up here that's being gained in the Northeast. However, you have the negative right here in DC, negative 1,000 in Maryland. So that's not really that much. It's a negative 1,000, but I think Delaware will probably end up turning soon because they're only at a 1K. But so this is kind of showing you where it might have gained equity, states gain some equity, and states that are losing equity as far as homeowners who purchase that their equity has been in the negative. So they are possibly going to see an upside down type of underwater situation. But let me, what did Lang say? Lang said, what is your recommendation from a realtor's point of view on how much to save for a down payment of a house going for 300,000, 400,000, 500,000? So what I always tell people is I say 7% of the purchase price. So 7% of the purchase price, I'm gonna do the math real quick. I always tell people that because typically close your down payment depending on what loan financing term you use. FHA, typically people put down 3.5%. You can go as low as 3% on a conventional. It just depends on different factors. Typically most people on conventionals will put around, if they're going on the low end below 20%, they'll put maybe 10% down ish per se. But let's just go with FHA because most Americans typically use FHA. So 3.5% purchase put down on FHA. And then you have your closing costs. Again, every state's closing costs might be different. Down here in Georgia, we range between 3 to 4% in closing costs. So right there you have, let's just say, most times I'm seeing it coming in around 3%. So you have 3.5% down payment, 3% of closing costs. Again, if the seller is nice enough or the new construction builder is nice enough, they might pay your closing costs. But right there you have 3.5%, 3%, that's 6.5%. And then you have that 0.5% left over for any additional fees. So a good thing would be, so well, now you might want to do, just to be safe, I would say between 7, I'm gonna just bump it up now just because how things are changing. 7 to 9%. I know it might be high. I don't know if David agrees with this, but 7 to 9%. So let's say, and the reason why I always bump up stuff higher is just because you factor in what any other fees that might occur along the way, or anything that might happen along the way. And then also when you close, you want to make sure you have money for yourself so you're able to buy furniture in your house, you're able to do other things, or just put money aside in regards to if something might break. Because even though you might go through a whole home inspection and everything might look good, even if it's a new HVAC system or a new furnace system or a new water heater, those new things can still break. I think people have a mindset of thinking just because it's new, it can't break. Anything new can break. A new TV, a new car, anything new can break, right? So we gotta remind ourselves that things can happen. So let's say 300,000, and let's just do it. I'm gonna do 8%. So for a $300,000 house, I would say save $24,000. For a $400,000 house, let's do 8% again, save $32,000. And then for a $500,000 house, let's do about 8% again, save $40,000. Again, your lender or other people might say, oh, you can be lower than that. I always like to do stuff and round it up just because I'd rather be safe than sorry. Even when I work with home sellers and we're doing like trying to figure out their payoffs and trying to figure out, closing fees and trying to figure out any prorated tax stuff or whatever, I always, or maybe possible closing costs, any compensation, I always overestimate everything, even with their payoffs, because like I said, some people are not honest with you as far as their whole situation. So if say you got to pay off $400,000, I'll say we're gonna put your payoff at $420,000. And I know I inflate the numbers crazy, you guys, but trust me, I do that purposely. One, because like I say, every time I work with somebody, whether it be a buyer or a seller, when we start pulling back that onion, people start to divulge more information. And then also, I always feel like that as well, because you don't know what else could come up. Maybe that person, again, maybe the seller might have liens that they need to pay off, right? Or maybe the buyer might have certain things. So I just inflate the numbers. And then at the end of the day, too, if you don't spend it all, or maybe you get more back than you thought you were going to get, you'll be happy at the end. Like, oh, I got more than I thought. And I'm like, we just want to be safe than sorry. So Lang said, okay, 7%, great. Yep, no problem. All right, so we're going to go from this article to, let me know if you guys have any questions, how you feeling about this conversation about people being upside down and different things like that, in regards to if you are trying to buy right now, or if you want to buy in the future. Again, like I said, have the conversation with the professional. Start with the lender if you can, have that conversation with your lender. Again, you can definitely reach out to a realtor you know, have them connect you with a lender they may know. But again, you also want to do your own due diligence. If you've bought before with another lender, or if you know somebody that you trust, you want to, get information from them, maybe do a some type of have a conversation with them, but also maybe utilize them. And if you don't know anybody and you want a recommendation, then you can definitely ask a realtor. But definitely talk to a lender. I always tell people too, if you want to talk to 3 different lenders, you can talk with a local, let's say your credit union lender. You can talk with a online lender if you want to, and then you can talk with a big bank lender. So it's kind of seeing like 3 different variations of different lenders, and then you can also talk to a broker. So you can talk to 4 different type of people and just see what they're saying, because they're all, even though they're all in the same financing field, you will definitely see some differences in the way and the lenders in which you choose as far as how they are structured in their business. Trust me, you will see it. People might say, I don't see. I'm like, you're gonna see the difference. I'm telling you. All right, so let me see this. So this right here is kind of jumping into even the investors. So corporate investors, if you guys don't know, in Atlanta, we have a lot of corporate investors who have purchased homes down here. We're about 30% in regards to corporate investors who purchase in the metro Atlanta area. If you head into Henry County, which is south of Atlanta, you have about 70% of those homes being corporate investor homes. And I tell people, be mindful of this. And if you are working with a realtor, no matter where you're at, because I don't know how investors bought in your state, but down here in the metro Atlanta area, or even outside in the surrounding area of once you kind of out of this perimeter and you start digging into some of these small communities and some of these new construction communities, I tell people, if you can, let's say you buy into this new construction community at the end of the new construction community, I tell people, try to see, ask your realtor, or if you want to do your own due diligence, go inside the tax records and see and label out all the houses around you that are purchased by investors. I don't know if I have an example of what I do for my clients. I kind of do. I think I might have deleted it. So let me see. I think I deleted it. But I usually do like a color coded thing for buyers, just because. And I do it now down here. Not right now, so I do it now down here because of what we're seeing, and I just want to be mindful that the buyers know as far as when it comes to some of the equity disappearing. So I tell people, if you're buying these subdivisions and these new construction places, try to do your research and see how many houses are investors. Because let's say you have a 20 townhome subdivision, right? You have a 20 townhome subdivision. Let's say 15 homes in that subdivision are investors, all right? And it's only 5 that are homeowners. If the investors all decide to sell all at the same time, or just say 3 or 4 of them decide to sell, when it comes to appraisals, typically most appraisers will take take 3 to 4 comparable comps, which are similar to your house. And if you're in a townhouse community too, you all have a similarity, right? So they'll take those 3 to 4 comps that sold, and then they'll say, okay, this is what the house is worth in your area now. So if you buy in a new construction subdivision or any type of subdivision, and there's a bunch of investors and they all decide to sell or something, and again, you bought the house for $400,000 and they all decide to sell at $350 all at one time, they will strip your equity out of your house. That's what's happening. And I've been talking about this on the last couple of lives. Trust me, you guys, I am seeing it. They will strip your equity, and literally the whole community, you will lose your equity. So just be mindful if you're buying in subdivisions with a bunch of investors, and really more corporate investors. You have mom and pop investors, which are a little different from corporate investors. Typically, the mom and pop investor will kind of, from what I see, they typically kind of hold on to their real estate a little longer than some of these corporate investors. These corporate investors kind of move accordingly to like where they see people shifting to. That's what I'm seeing. I don't know if David is still here and that's what he might see, but that's what I see. So I just say be mindful. Again, it might be hard for you to tell if you're buying a new construction community right now, or if you bought one before, and if you bought at the top of the new construction community, because typically in new construction, in the beginning phase of it, the home prices will be a little cheaper per se, and then as they keep building in different phases, it goes up in price, and then as they get to that last phase, it'll dip down a little bit more in price. but it typically won't go below what the first phase of homes sold for. But at the end of the day, if you bought in the beginning phase, you might not know what might happen in the middle phase or the end phase as far as if any investors buy. And what I've been noticing lately, especially down in the metro Atlanta area, because there has been a softening and home buyers kind of sitting on the side and they don't want to buy right now and they're a little skeptical, more investors per se, or corporate, some of these investors have been purchasing some of these new constructions. So you're getting a lot of these homes purchased by investors. And if you just bought in that community and you didn't realize that, it's, so I don't know. I just say, and I just stop talking. Let me know, you guys, if you have any questions. Don't forget to subscribe to the channel, like and share, hit that notification bell. I appreciate everybody for joining me this Father's Day. Again, if you weren't here in the beginning of the live, happy Father's Day to anybody who is on the live, who is either a father figure. Happy Father's Day to you. Hope you guys are enjoying your day. And I appreciate everybody being here on this Sunday to have this conversation in regards to real estate. All right, so now let's get into this article. It says, Realtor.com investor report, investor buyers share edges higher, investor share of sellers peak. So we're going to get through this real quick because I want to dip into more stuff before we get off this live. It says investor competition was front and center for many hopeful home buyers during the COVID-19 pandemic. Low inventory levels meant that many buyers were competing with investors for scarce inventory, and investors often won. This is what I saw a lot in that time period too, where basically any first-time home buyers that were looking at a lower price point or had like a smaller budget, they were getting beat out in like 2.5 seconds by investors. Like I had a client that was looking in 2023. We saw this townhouse unit. I don't know if she's on here tonight, but she knows who she is. We saw this townhouse unit. She wanted to be able to call her husband and just kind of get him to come back and look at it with her. And then literally as I called the agent, they said, oh, we're under contract. So that's what was happening in 2023. Is it happening now? In Metro Atlanta area, it's not happening like that. I don't know if it's happening anywhere else. It might still be happening in the northeast part and stuff like that, but down here, that ain't happening. However, the housing market has shifted significantly since the pandemic era. Frenzy inventory levels are returning to pre-pandemic norms. Home price growth has leveled out and rents have eased. We took a look at an investor activity in U.S. housing market throughout 2024 to understand the ongoing impact of investors shifting in a shifting housing market. It says right here, we use data and to identify investors. The goal is to get a reading on buy and hold. So the buy and hold are basically people and long-term investors. They're buying, they're holding property. So they'll probably end up either one, renting it out. Oh, Lord, I got a spider on my computer. Sorry, y'all. I just saw this spider crawl. Give me a second. I don't know where. I'm sorry. I don't know. I just hit it and I don't know where it went. It's a spider crawling around here. All right. These daggone insects are taking over. So I don't know where that spider went. I'm sorry. I just interrupted the whole live because I saw the spider crawl. But all right, back to it. So and then I'll get the spider when I get off of here if I can find it. I just hit it somewhere. I don't know where it went. All right. So the investors, David said, great stream. Thanks, Clark. No problem, David. Thanks for joining me. It has definitely cooled here. It's cooled in Nebraska as well, too, as far as corporate investors. So it says you have the buy and hold investors who are typically buying a real estate. They're holding it, whether they're turning them into long-term rentals or they might just buy them and hold them and never put nobody in the property and just sit on it until they feel that the market has changed, things have shifted. And then it says corporate investor activity, the data. So then again, they're talking about the corporate investor activity. The data does not capture mom and pop investors unless they buy using a corporate entity. All right, so it says investor purchases picked up from about 608,000 in 2023 to 610 in 2024. Though modest, the increase in investor home purchase, what's going on? Home purchases came at a time when overall home purchasing slumped, resulting in an uptick in investor buyer share. In 2024, 13% of homes sold were purchased by an investor, up from 12.7% in 2023, but still below the 2022 peak of 13.3%. Home prices and mortgage rates remain elevated through the year, eating into overall buyer demand. Investor purchases picked up 0.4% in 2024, outpacing the 2.1% decline in 2023. in total transactions, which dropped total home sales to a decade plus low. Let me see if you guys, sorry, you guys. I'm like trying to find the spider now, so now my mind has gone somewhere else. Hey, what's going on, Kevin? Thanks for joining the live. Thanks for joining. I appreciate you. Happy Father's Day to you and to everybody else who's just joining us right now. If you're a father or a father figure, we appreciate you guys. Happy Father's Day. So this is basically talking about small investors accounted for 59.2% of investor purchases in 2024, the highest small investor share in the data's history since 2001. Larger investor activity fell. So these are the large investors. So corporate investors, it says it fell to 21.7% of investor purchases, the lowest since 2007. Small investors purchased 361,900 homes in 2024, up 3.7% year over year. Large investors purchased just 132,500 homes, down 8.7% year over year, and the lowest since 2018. So basically, these large corporate investors, they are sitting on the sideline as well. They're trying to see what's going on. So they decide, hey, we're going to still purchase, but we're not going to purchase it in the mass as far as what we purchased in the whole pandemic era or the whole 2007, 2008 era, right? So they're kind of cautioning and they're sitting back on the sideline. So that's why if a buyer right now, if you've been trying to buy, you might find a little bit more easier, right, to be able to buy a home because you're not getting outbid. You're not competing with so many people. And you still got some of these mom and pop investors, like they were saying, buying right now. So they're buying more than the corporate investors because they're like, okay, this is the market where I feel like I can possibly get something, maybe low ball offer, some deals per se, and maybe get something to stick without having to compete against somebody that might come in with, say, a all cash offer or any type of certain terms per se that they won't be able to match, right? So so even investors, you guys, they are sitting on the sideline. The corporate investors are definitely sitting on the sideline. And then what did Corey say? And I'm gonna share this, and I'm gonna get you up, see what you said, Corey. Sorry, I'm sorry, you guys. I don't want to rush, but I don't want to keep you guys here too long because, like I said, I'll keep running my mouth. I gotta find this dang spider too, because this spider just randomly crawled around my computer, and then I hit it, and I don't know where it went. Croy said, Clark, if buying in a town home community or new construction, would there be a limit on how many units investors can purchase? So yeah, it could depend, right? It depends on the HOA put in place when it comes to buying a new construction townhome community, whether it be single family townhomes. If they put an HOA in place and they say there's a rental cap, it can, be a certain amount of townhomes or new construction that can be purchased in regards to rental properties. However, like I said, sometimes if a new construction community is kind of seeing a slow pickup in regards to home buyers purchasing these homes and they're trying to exit out at a certain time frame or a certain and within a certain amount of months, they might allow an investor to come in and maybe buy a couple units and kind of be above per se where they might want to put the cap at. But yeah, you have some townhome, new construction communities and townhome communities that have HOAs put in place in which they create rental caps. Typically, most of what I see down here in Georgia, they'll put at like a 10% rental cap. And then I do see a lot of condo buildings down here where it might be almost close to like a half and half situation in some of them. Not all of them, but like some of them might say like, you might have it where in order to qualify too, Kevin's on here. I don't know if he'll say anything in the chat about it. But in order for like some of these communities too to qualify for FHA and different things like that, there has to be a certain percentage of homeowners, especially when it comes to condos too. So I don't know if Kevin can divulge in that or let you guys know in regards to that. But yes, there definitely is a limit in some of these communities, and then there's some that don't have no limits. So I just tell people just be mindful. You can definitely ask new construction people, hey. If they say there's going to be an HOA in place, say, hey, if there's an HOA in place, is there a rental cap? And if they say yes, like, well, what's the rental cap? Typically, if you ask them if there's a rental cap, they'll automatically tell you percentage. But you can ask them if they don't, say, hey, well, what's the rental cap, right? Let me see. Did I answer your question? Sorry, Corey. I don't know if that made sense or not. All right. So right here it says the gap between new construction and existing home prices narrow. Builders committed to promoting homeownership. So if you guys don't know, there's a gap now shifting as well when it comes to the resales versus the new construction. At one point, there was a big difference between buying a new construction house and a resale, and now the gap is getting narrower, and it's becoming closer and closer in regards to new construction and the difference of buying a resale. The only thing that's happening now, what I'm seeing down here in the Metro Atlanta area with some of these new constructions, is that they're buying down your interest rates, whether it be a fixed interest rate buy down, whether it be a 2-1 buy down, a 3-2-1 buy down. They're buying down the interest rate, and then they're offering these big incentives. So a lot of resales can't do that. I'm not saying I don't want to say they can't do it. Most of them can't do it. They might not have the funds to pay buy down. Like, they might give you a certain amount of closing costs, and then you as a buyer can ask your lender, how can you utilize these closing costs? Can you utilize them to try to buy down the rate? Can you utilize them towards, HOA fees or whatever you guys want to utilize them towards, as long as it's allowed through your lender per se. But that's where we're kind of seeing the new construction kind of winning right now, because they're doing these interest rate buy downs, they're doing these large incentives, and so that's how they're kind of beating out the resales right now. Kevin says some have limits of FHA, some have limits for the amount of investors in those communities as well. So there you go, Croy. So he's saying, like we kind of talked about earlier, they have limits. Some have limits for FHA, some of them have limits for investors in those communities. So just gotta, have more of a conversation when you're looking to do stuff, and just talk and see what makes sense and for you, right? But yeah, so in regards to this home buyer, these homes, new construction says that the National Association of Home Builders celebrates National Homeownership Month, which June is the National Homeownership Month. So if you guys don't know, home buyers are discovering a narrow price gap between new and existing homes. During the first quarter of 2025, the median sales price of a new home was just $14,600 more than an existing home. Home builders are committed to ensuring everyone who values homeownership has the opportunity to attain a safe, affordable home. That's what they said. Let's get down here. The median price for a new single-family home sold in the first quarter of 2025 for $416,900, only $14,600 above the existing home sale price of $402,300. So the new construction was at $416,000, and the resales are around $402,000. It says right here, the average difference over the last 5 years was $26,700, while the decade prior, 2010 to 2019, saw a much wider gap of $66,000. So again, the gap is getting narrower in regards to new construction and resale. So you saw for 9 years there was a gap from 2010 to 2019 where the new construction was $66,000, and now we're at, as of right now, because of the way the market is softening, depending on what market you're in, because like we talked earlier, Northeast, for some reason, prices keep going up. But we're seeing a narrower gap. It says, let's get down here. There are several reasons why new and existing homes are selling at a similar price point. For existing homes, tight inventory continues to push up prices. Many homeowners who secure low mortgage rates during the pandemic are hesitant to sell due to elevated interest rates. It says both new and existing homes saw dramatic increases in prices post-pandemic due to higher construction costs and limited supply. So yes, these are kind of all talking about the same key points, right? That everybody keeps hitting. Oh, the lower inventory, people don't want to move because they bought at lower interest rates. Maybe some people don't have mortgages, so there's no need for them to sell. Maybe some of them are keeping it as generational thing where they're keeping it in families so people have somewhere to go as they grow older, and as people kind of leave the earth per se. So they want to have something for their kids, their grandkids, so they're just keeping the home in the family. Again, just make sure if you're doing that, just go through the proper channels to get everything set up if you don't have a trust. And if you guys missed our conversation with Whitney, who is an attorney in regards to probates, trusts, wills, and all that stuff, we'll have her back on. She's joining us again June 29th, which is a Sunday at the end of this month at 7 p.m. again. So we'll have the conversation around a POA, which is power of attorney, more about probate and wills and trusts. So if you guys have any questions that you didn't get to ask her last time, please write some questions down for her and get ready for a more in-depth conversation. And and I got to figure out some more questions myself. I feel like I asked a lot, so I kind of want you guys to come and dig into it if you can, and if you can join us, I would appreciate it. Kevin said, we have 15 people watching. We need 15 likes for this video. Thank you, guys. Yes, please. Thank you, Kevin. Yes, please don't forget to like the video. It helps to push this channel through the algorithm some more. I appreciate everybody getting us over here at 1,000+ subscribers now. We just got to get our views up on this channel. So please, even if you don't want to watch me or hear my voice, you can put me on mute, walk away, just hit the play button and let it play. Try to play through these videos so we can get the watch views up as well. So we can kind of hit both with the subscribers and the watch views for the channel. So again, if you don't want to listen to my voice, I know it might be a little annoying at sometimes, and I talk a lot. So if you could just put me on mute and just press the play button and walk away, that would be greatly appreciative. I thank you guys. Thank you, Kevin. So yeah, so we're seeing that gap in new construction and resales. So right now you might see that the resales might be catching up, or they might not be too far off from the new construction. So some people might feel like that as well, that, oh, well, what's the point of me going to go buy a resale when I get a new construction at only, let's say, $10,000 more, or maybe it might be a little less, because I know some resales in the Metro Atlanta area are higher than some of the new construction. But again, most of the retails that I'm currently seeing that are higher than some of the new constructions are because some of these people bought 2022, 2023, or even 2024, and things happen, and they're trying to sell their home, so they're higher because they're trying to make sure they don't have to bring no money to the closing table. But you might have to bite the bullet, right? If you're trying to sell and you need to get out of a situation, you might have to say, hey, either contact your lender, see what they can do, what type of options are available, or if you don't have any options available for you, then you might say, hey, I'm just gonna bite the bullet, and whatever I can bring to the closing table for the difference, and I'm just gonna have to make happen. But I'm seeing people who might have equity in their house. So most people that bought earlier than, like, say, 2022 and all that stuff, they still have equity in their house, right? Because the way the market shifts, even though the prices went up high and they're shifting down in certain markets, there's still some equity in that space per se, right? So they're like, okay, I can afford to keep bringing the price down because I'm still going to make out, because I do have equity due to this fairy tale of the pandemic that has, really drove up the prices in homes. And with that being said, they are able to do that. But most people who are trying to get out of it because they can't, things happen, they don't want to be a homeowner no more, the maintenance, the insurance, the taxes, you don't have that space to do so. So you got to be creative, think of ways to talk to your lender, see what options are available. Or at the end of the day, if you want to just bite the bullet and try to see what you could do and maybe not bring so much to the closing table, but just a little bit to the closing table, it just depends. Again, everything depends on you as a person, what your aims are, what your goals are, what you're trying to do ultimately. Lang said, it was a great show. Happy Father's Day to all that apply. Yes, happy Father's Day, you guys. So I'm going to show you something real quick, and then I'm going to talk about the deeds, and then I'm going to get off here, you guys. So I just want to show you guys down here in Georgia, we're seeing home price reductions of basically $100,000. So I don't know if you guys can see this. Let me make this big real quick. I'm going to hit on these two, from like $100,000, $75,000. So again, it depends on where you're at. Do your research, talk to your realtor. If you are trying to buy a home in this situation, just be mindful of what's happening. Understand, create your own strategy, see where you ultimately want to be at. But right here, as you can see, this house, they were listed originally at, let me see. They were listed originally at seven. They came on the market for originally at $775,000. And now they're at $650,000. So they're down $125,000 of the purchase price. So you do have markets, you do have areas, again, depending on where you live at, you might want to say, hey, this is shifting down. Let me see if this makes sense. Some people are still like, well, if it's shifting like this, some people are still on the sidelines trying to wait. Again, I don't know your situation. I don't know what your ultimate goal is. Excuse me, I'm like, you can wait, you can see what happens, but then waiting could also cause another turn where things could possibly inch back up too. So I don't know, just make sure it makes sense to you, but we are definitely seeing a shift. So that's one house down here. So that's $125,000 shift. Let me show you guys another house. Don't mind me. Sorry, I'm like rushing because I don't want to keep you guys too long. We went over time. So, and right here you have another house that came on the market. Let me make this bigger. Is this big enough for you guys to see? Came on the market at $525,000, and they sold for $450,000. So, and I have to use the Zillow because again, in the MLS, it'll show that the address and everything. So I don't want the video to get flagged because I feel like there's a lot of important information in this video. And then whoever comes back to watch it later on, I want you to be able to hopefully pick up some good information. But yeah, so you can see that. So that's about a $75,000 softening correction per se in home prices. So we are seeing a shift. We are seeing things go down in prices. And then I just want to talk about this too. I had this conversation with a friend. Lang said, "Take your time here." I know I'm trying to rush because I don't want to keep y'all all night. But I appreciate you saying take my time. But I'm not gonna keep y'all that long. And then I'm gonna have a conversation. So I'm a realtor. Every state is different, but I want to talk to you guys too about when you buy a house. I don't know. We talked about this on the last live per se. When you take title with the house, and the only reason why I'm bringing this up is because your attorney or your title company, however you guys take title in your state or however your closing goes, they'll kind of talk to you about this. But these are questions you want to ask if you're taking title. Every state takes title different, has differences in which way they take title. In Georgia, most people take title in joint tenants with rights of survivorship or tenants in common. So tenants in common. So again, this is if you're buying a house and you're taking title on a house, what might be the best way for you to take title, depending on how you want your assets to be divided when you should happen to, let's say, move on or pass on from this earth or things like that. Let me get out of here. So tenants in common, this is the legal entity that courts assume if the deed is otherwise silent. This means if there are two people taking ownership and one dies, that the person's half goes to his probate or her probated heirs, not directly to the other owner. If there are three owners, each actually owns a third. 4 owners own a quarter, and like that. So basically, if you guys take title as tenants, Corey said, he said, no need to rush, this good. Okay, thank you guys. I appreciate you guys. So if you take title as tenants in common, basically what it's saying, let's say there are 3 friends, right? They buy a house together. They decide to take a title or ownership as tenants in common. So with the 3 people, one person dies and you have 2 people left. So that one person that died, say they had a daughter, or so then that daughter per se would then be the heir that would inherit that person's portion that passed away. So now you still have the 3 on the title, but it's different as you have the 2 main survivors, and then you have the person who passed away, their heir takes title as far as when it has to be probated. Thank you, David. He said, agree, take your time. Thank you. And let me know, David, too. I don't know how you guys kind of take title in Nebraska. But in Georgia, we see a lot of it as far as tenants in common and joint tenants with right of survivorship. Again, I'm not an attorney. These are just small information and small things that that could be purposeful, hopefully, to you if you're buying a house and you understand how you want to understand which is the best way for you to take title. Again, you always want to make sure when you sit down at the closing table, you ask whether if you're in a state that has closing attorneys, a title company, ask them which way are they going to put you on title, and then talk to them about what's the best way for you to be on title. So that's tenants in common, if that makes sense. The next one is joint tenants with rights of survivorship. It says in the case of a death, this deed given the surviving owner the entire property. So if there is a non-married couple with kids from prior relationships and one passed away, his or her share automatically goes to the remaining partner as the new sole owner. That person can later choose to leave the home to anyone they wish, excluding their late partner's children if they desire. So this one is very interesting, you guys. So with joint tenants in common, again, when you take down here in Georgia, this is another way in which someone can take title. So when you take title as joint tenants and with the rights of survivorship, even if the person is not married as they stated, they're on there as equal owners in the title of the property. So in which so if that person, let's say the husband dies, or not the husband, the man dies, the wife lives, but the man had a kid, and the property or the titles to said property, everything gets transferred over to the woman who survived. She has 2 kids. She decides when she passes away that she wants her kids to basically get the property, and the man's child will not have rights to the property. So you got to make sure you guys title correctly, because even though they were together, even if they were married or not married, with joint tenants with the right of survivorship, is whoever is on the title, those are the ones that get the right to title after said person dies. So if there's 3 people on title, you're at joint tenants with the right of survivorship, 2 people died, and 1 person left is the sole owner of the property, and they can do however they want to, whatever they want to do with it when they pass away, however they want to execute it, however they want to leave it. They are the ones that have the sole right. So if they end up, changing whatever they change or divvy stuff up the way they divvy it up, it becomes their right to do so. Hopefully I'm explaining that you guys understand. I hope I'm not making sense and talking in circles. Tenancy by entireties says this can only be used for people who are legally married. So you have to be legally married to use this one. Similar to joint joint tenants with rights of survivorship, each party owns 100%. So if one passes away, the property automatically goes to the other. Unlike joint tenant with rights of survivorship, however, if a judgment is entered in court against only one of the owners, it cannot become a lien on the property. So so with joint tenants to the right of survivorship, if it's like they say right here, unlike that one, there can be a judgment put against and become a lien on the property with joint tenants with the right of survivorship. The tenants by the entireties, or tenancy by the entireties, if there is a lien put on a property, a judgment that happens to go to court, it cannot be put against the owner of the property and all that stuff like that. It cannot become a lien on the property when that owner owns it. So again, hopefully that's making sense. So I'm just bringing this up. Again, you want to talk to, again, depending on what state you're in, talk to your closing attorney. In the state of Georgia, we have closing attorneys. Some states like Pennsylvania, they use title companies. Talk to them, see what's the best way to get on your title. Or even if you are currently a homeowner and you have a title, go back and see how your title is, how you took title, how they put you on title, and have a conversation and see what makes sense in regards to the way your title is. And then of course we have a trust, which we all know. We talked about it with Whitney about a trust. A trust can also take title to a property. So again, in order for a trust to take title to the property, you have to fund the trust, like Whitney said. You have to make sure you actually deed the property into the trust. You just don't make a piece of paper and write on there the property's address and think that's a trust. It has to be deeded into the trust. It has to be funded per se, like Whitney said. If you have a pocketbook as a woman, and you have to put things in your pocketbook, right? So you have to fund it. You have to deed it into the trust. So that's a little bit about taking title. That's a short conversation. If you have any other questions, you can let me know. Hopefully I explained it enough where it makes sense. And again, every state is different. So you have to ask your state uses attorneys or title companies, ask them what type of ways can you take title when purchasing a house, or even if you want to look into your current deed, the title per se, and see which way in which you guys took title. All right. So hopefully that made sense. And then the last thing I wanted to get into, which I couldn't find an actual piece of an example of it, is basically like your settlement statement. So if you guys are buying a house, I was trying to find like an example of a settlement statement, because of course, because it is a document in which you get at buying a house. It's not going to be on here like that, but let me see if I can click on this real quick. I don't know if this one will open up, but Anyway, let's see. I'll just show you guys the screen real quick, and then we will hop off here so you guys can enjoy the rest of your Father's Day. Okay, so a settlement. Okay, of course. Why? So I don't know if you guys can see this. Let me see. I'll make it real big, real quick. It might be a little blurry. So this is a settlement statement. If I got this whole stuff in front of me as far as download for free, I don't know if you guys can see that. Let me go real quick, make it a little bit more bigger. All right, so a settlement statement is when you buy or you sell a house, you'll get a settlement statement. It's kind of, this is like, ours don't look like this in Georgia. It looks similar, but not in totality like this. They can vary depending on what state you're in as far as how they kind of create the document. Hope it don't look too blurry. It looks kind of blurry, so I'm gonna stop sharing it because that looks blurry. Sorry, guys. Let me see if I can find one real quick. I was trying to find this before I got on here and I couldn't find it. If you have any questions, let me know. I'm gonna see if I can find a settlement statement real quick. And the only reason why I want to talk about this, and I don't know if Kevin's still on here, but I only want to talk about this because what I've been noticing, and I could be wrong, and if Kevin's on here, correct me, is that when people are buying new construction nowadays, and these new constructions are saying like they're buying down your interest rate and things like that, people are like, oh, I'm getting a lower interest rate, but then they don't know on the back end on the settlement statement is that some of these lenders that are working hand in hand with the builder, they're actually adding some those points into your loan. So you're actually paying, and maybe not all of them, but some of them, the statement, like if you look on your settlement statement underneath of where it says loan charges, it'll probably say like discount points. And discount points typically are when you're paying for like a lower interest rate. And you could correct me, Kevin, if correct me, let me know. But typically that's what you're paying for is the interest rates. And I don't know if Kevin's still on here because Kevin is a lender in Georgia. So I was trying to get our lender to make sure. But so if you are, sorry guys, I'm trying to find a settlement statement that's not blurry. So if you are, buying a house right now, and if you are looking at, I say fill in. This is fill in. Let me see if this will pop. Give me something real quick. And if you are looking at that, take a look at the settlement statement. They have to, by law, they have to send it to you. Your closing, your settlement statement, all that. They have to send it to you within 3 days prior to closing, so you can look over the documents, and that way you can ask any questions in regards to the numbers on the documents. And of course, it's not loading, but I would definitely ask the question in regards to anything you see on there that doesn't make sense to you. I'll just read it off for you guys real quick, so because I can't find one that'll open up. So depends again in regards to your settlement statement. I can't really, well, so this is what it typically looks like. I'm trying to cover this. So it looks like something like this. I don't know if you guys can see it. That's a settlement statement. It might be a little blurry, but I can't really divulge it because it's personal information. That's why I was trying to give you guys an example, and I had one put up earlier and it disappeared. Let me see if this one works. Hopefully, I don't know. This might come a little bit. Share this real quick. Sorry, y'all. Share that real quick. All right, let's talk about the settlement statement real quick. So this is a little example. Everybody's settlement statement might look different. So you have your borrowers over here, you have your sellers over here, and your settlement statement, right? And again, you want to talk to right here when your settlement statement comes in, you want to talk to your attorney, you can talk to your lender and different things like that. But there's different fees that occur. All the fees are not broken down on these settlement statements, these examples, but you'll see the different fees. You'll see the borrower's transaction. You'll see like the contract price as far as what they're buying it for. You'll see any charges per se. You'll see over here how much the seller is selling it for as well. You'll see the different taxes that might have to be paid or might be credited back or might have to be paid. So the seller might have to pay some on their end. They might credit it to the buyer. Or the seller might have already overly paid, so they might credit some money back to the seller in regards to taxes. Down here is like the little small things, earnest money, all that stuff. Ours is a little bit more different from this. I'm trying to see some things. Yeah, so anyway, that's what a settlement statement looks like. So we can get the gist of what a settlement statement looks like. And then I'm going to read off some fees down here real quick in Georgia. And again, you can have conversation, everything. But the purpose, again, of bringing this up is that if you are buying a new construction property and they do go on there and they say, hey, we're offering low interest rates right now, and then you get your settlement statement, and then underneath your loan charges, you see discount points added, I would ask the sales agent at the new construction to ask the lender, what exactly are these discount points for? Typically, the discount points is the buy down interest rate. So you might think that you're getting a lower interest rate and you're getting it quote unquote for free, but really is being added in. It's being added in. So just be mindful. Kevin obviously is not on here no more, but I typically tell people to say, like, what is the par rate in regards to the interest rate? And if you're talking to in a new construction and they say, oh, we have an interest rate of 4.99 buy down or whatever, and you can ask them like, oh, okay, is that the par rate? So the par rate basically means that's the rate that they're giving to you. They're giving you without any charges. They're not charging you discount points. So if you see that on there, that means they charge you to buy down that rate some way, somehow. You'll also typically see on it down here in Georgia, you'll see, of course, other loan charges. You'll see your appraisal fee. Like I said, down here in Georgia, we're seeing around 550, 650, 700. But really we're seeing 550. You might have a certificate report fee, which we see down here in Georgia. You might have a flood certificate fee. We have a MERS fee. So different fees you'll see on there. You'll see, of course, the home insurance stuff that'll be on there as well, property tax stuff, and then you'll see the title charges. They don't have it on this example of the settlement statement, but you'll see like title charges, and it'll tell you how much the lender's title insurance as far as them pulling it, other titles information, settlement or closing fee, those different things. And then you'll also see like recording fees, transfer fees, as far as them recording the deed, different things like that. So what I've been noticing down here in Georgia is that our deed recording fee is like $25. Our recorded trust deed mortgage is like $25. Our GRMA fee is $10. That's all typical across the board, which I've been seeing at every closing when I read the settlement. So those are just some things in regards to the settlement statement. I wish I would have had more information. I feel like I don't know if that's knowledge, like enough information per se, because I couldn't really pull up the actual settlement statement. I had one before and then it disappeared. But nonetheless, I want to thank you guys again for joining me on this Father's Day. One more time before we get off of here, happy Father's Day to any fathers that are on the live tonight. Anybody who has been in the home acting as such for as a father or any type of figure per se. Happy Father's Day to all of you. I appreciate everybody for joining the live tonight. Let me know if you guys, need any information. If you guys have any questions, you can always reach out to me. My information will be below. My email address. If you guys are looking for a realtor in the area of Georgia and you want to have a conversation with me, you can also email me as well. Don't be scared. I do get people who reach out to me to ask questions or to look into things. So you don't have to be scared. And if you do need a referral to another realtor in a different state, different city per se, you can reach out to me as well. I want to thank everybody again for joining me tonight. And don't forget, if you guys have not subscribed to David Matney's channel in Omaha, living in Omaha, David Matney, head over to his YouTube channel and hit that subscribe button. He goes live every Tuesday, 8 p.m., which is Eastern time or my time. He goes live. So if you're on the East Coast, it's 8 p.m. Eastern time. He has wonderful information over there, very knowledgeable and great guests that always come on there to give you guys more information in regards to the real estate field. All right. So thank you again, Croy, for joining me tonight. Thank you, Lang. Again, Lang's birthday is tomorrow. So if you guys want to, you can put in the chat now and give her a happy early birthday. Thank you, Kevin, for joining us tonight as well. Of course, thank you to Donna. Thanks for coming on as well. Thanks to Jaron for stopping by tonight. And thanks to my dad and everybody else. Thank you. If you didn't make a comment in the chat, thank you, Angela Matney. Thank you, Anthony Matney, and everybody else who joined us tonight. I appreciate everybody. And if I missed you guys, blame it on my head and not my heart. But have a wonderful night. Take care, you guys. Bye-bye.